welcome to the Capital Discussions Road Trip Trade Alert Weekly Update. I'm Tom Nonamaker with Dan Harvey. Welcome everyone. We're showing currently the SPX Combined Positions. We haven't done that for a while, but you can see we have up here about $1,100 versus the 473. So we have some theta across our 4 open trades, but things are very flat. So we did have quite a runoff. If you look at the price chart of SPX, at that 32-point move yesterday. So pretty good chance we could fall back with some profit taking tomorrow. So we're not in any big rush to start reverse harving everything and taking risk off on the down, taking more risk on the downside, reducing potential profit if the market does move down in exchange for, just a little bit of a bump up here, because the market is a little bit overextended and good chance it could come back a little bit. So we're not in too big of a rush to reverse Harvey, at least right now. But let's take a look at the trades by themselves. This is the, when is this? This is the July 29th expiration. And you can see we've run well above the 10th at this point. And if we look at 21 days to go, the 2 standard deviations is just below the expiration break even on the downside. Probability of touching the short strike is 8%, which is getting pretty low. Anything under 20 is low, but under 10 is getting really safe. No guarantees, of course, but any more plans to reverse Harvey with this one, Dan? I know it's kind of running out of premium.
Well, it is, and actually, I share your thoughts exactly. And the market, when you look at the market internals, they suggest to me that we're a little bit overbought. And so, obviously, I think we may be long-term bullish. At least I hope we're long-term bullish. But for the intermediate or the short term, it seems to me we're a little bit overbought. And recently, I've had some really good questions that came to the service about doing a reverse Harvey. There's a couple things that I would want to point out. Well, one of the questions suggested, why don't we go ahead and do a reverse Harvey on this or that? And the reverse Harveys are not to be taken lightly. Their main purpose is to raise up the right side of the expiration curve, just as you see it there. When you do a reverse Harvey, even though you receive a credit, you're not actually making any money, by doing that. What you're doing is you're locking in the money, some of the money that you've already made, but you're doing that at the expense of 2 things. Number one, you're doing it at the expense of making more money if the market drops off, pulls back. And number 2, you're doing it at the expense of a little bit more risk, because every time you do a reverse Harvey, your family of curves are going to slope a little more to the downside. So it's not to be taken lightly. It's sort of a balancing act, sort of an art form as to when to do it and when to leave it alone and hope you can make more money from a pullback. So for this particular trade, I would say that some traders that had this position, obviously we can't make any specific trade recommendations, but some traders that had this might choose to say, I've made all I'm going to make. I'm just going to take this money and maybe use it for something else. But other traders may say, well, there might be a little bit more. If we got a pullback, I can make an extra couple hundred. And then the other thing that I will frequently do on a trade like this, and maybe you do it as well, Tom, and that is to put in a good till cancel order to take out some of the butters at a price which is better than the current price. Because, every now and again, you'll get a fill on that, and you may bring in a couple $100 that you didn't think you were going to make. So that's the way I would handle this one.
And if you want to figure out what the current price of a spread is to figure out what you may want to put one out for offer, if you this is kind of a nice trick. If you left click here and hold the shift key down, it'll be a plus. If you right click, it's minus. So I'll do like this. And now I've created a butterfly, and if I use the spread button, I can see the market price is 40 cents for that butterfly. And I'm just going to do it one time up here. Hit enter. So there's my trade. But if you say, okay, it's trading at 40 cents, maybe I want to try and sell it out at a dollar or 60 cents or 90 cents. So, this is the current price, and, it's kind of a complex butterfly if you look at all these positions, but you can just sell part of it too. And now
Sure.
you know what this price is at, and just, bump it up as much as you want and put that good till cancel order out there, and maybe you'll get filled and have a nice lunch. So,
And that's exactly the way that I do it. And recently, for those that haven't seen, Tom and I made a very short video on how you set up a good till canceled order on Thinkorswim. That particular example was on a vertical, but you would do the same thing on this. You just would specify the price as a limit order for for higher than the current price, and you'd be surprised the number of times that this will be filled, where before you thought, well, I'll just have to either hold this until expiration or take it off, but now you made more than you thought you would. So it's a useful
absolutely.
trick.
Very good. So, just looking at this before we leave this trade, any thoughts on? Personally, I would just leave this as is, and you have a little lottery ticket if you come back, one standard deviation.
That is what I'm going to do, just leave it. So I don't really have any plans for this one at all.
Yep. Okay, so on to the next one. This is our big problem child at the moment, the August 18th. I'll get blue. Oops, I just went past it. Okay, so let me just zoom out a little bit because it's starting to get kind of far away. All right, so here's the August expiration, August 18th, and minus 1169. We're at minus 13, so we're about $200 below that. So at expiration, it will come up to here. We still have 41 days to go, which thankfully means we have some premium in here. Probability of touching the short strikes at 9%, so that's nice and low. But you can see we've reversed Harvey, and this it's almost like having a put credit spread. So, we're not going to make anything up here, but we do have risk on the downside.
Well, that's exactly right. This is like the old country saying, a redheaded stepchild in a family of brunettes. And no offense to redheads, of course. When I was a young man, I had a thing for redheads, but that's another story anyway. But this is a mess, and it's mainly a mess because of the because of the long put that we never did make back. When I added that long put, and when it was a hit, the hope was that we would have a gradual return, chunking out theta, but instead we rocketed to the upside, and that's the main reason. Now, in hindsight, which is 2020, of course, a debit spread, a wide debit spread, would have served us a lot better than that long put. But with Brexit coming up, I felt that I had to protect our positions. But we're kind of paying the price for it now. So I'm just going to let this one sort of percolate up to that point, because if I tried another aggressive reverse Harvey, I would really, really increase the risk, and I don't think it is worth it for a trade that is already a dog. So sometimes you just have to, eat it, and like the Kenny Rogers thing, you gotta know when to hold them and know when to fold them, and we may be folding this guy.
Yep, there's not a lot we can do. I mean, even if we did, say, a wide bullish vertical like this, that lifts it up a little bit, increases the risk back over 20, almost 23,000. But you see, it just, your risk goes up quite a bit, but you go from minus 1167 up to minus 969. So you're only adding $200. You can see that 520 versus 313. So about $200 per spread, but you're taking on a lot of risk to do that. And you can see the T plus 0 lines really falling off a lot quicker. So it's because it's so far away, it's going to be tough to recover that 1,100.
Well, that's exactly correct. And to me, it's certainly not worth the risk to do that. Some traders with a PM account might choose to add a far out of the money call spread, but again, you're only bringing in a couple of $100, number one. And number two, what if we keep on marching to the upside, then your call spread is being hit. So, sometimes it is valuable, which we won't be doing this in the road trip trade service, but for just as a general statement, sometimes you can superimpose, other trades, on top of the road trip trade to make it a broader range of profitability. But this is an advanced type of technique, and if you do that, you have to do it much earlier than now. There's really no good, safe way to save this trade.
Yeah, and if you were trying to layer something, somebody could try something like this. But again, look how much risk you're taking if you did that. So, we don't like to take a lot of risk, and we do have occasional losses. So,
yeah,
this is one of those trades that you're kind of running out of ideas. I even looked at maybe rolling up the whole butterfly, but again, that's also problematic. So, I don't really see any good solutions for salvaging this one.
Yeah, that might have worked if we'd done that a week or 10 days ago, but I think with the amount of time remaining, I just don't see how we're going to generate a lot of theta for this guy. And, again, folks, it's all about positive expectancy. So we're not generally trying to hit home runs here. We're looking for lots of doubles and triples and maybe an occasional, may want to hit one in the corner and get a triple. But we're not going to be making, 50% return on any road trip. But we are going to have lots of winners, and I mean lots of winners. But the corollary of that is we will have occasional loser, and this is going to be one of them.
Yep. Okay, so let's move on to our next one. This is our August 30th, the quarterly or the monthly trade. Let's see, that's 53 days to go, up nicely to $614. This is one of those trades I think right out of the gate. This has been profitable. So
yes,
sometimes they're easy, sometimes they're hard. This is an easy one.
Yeah, this one actually, is sort of characteristic, and befits the name of road trip trade. I mean, you likely will have to do nothing on this, except maybe at some point do a reverse Harvey, again. But this is worked from the very beginning, just like Tom said. And sometimes you get these, and of course we like these because we don't like to do any more to these than we have to.
Any thoughts on rolling this butterfly a little higher to get more out of it, or would you just kind of leave it as is? I know obviously it's more work to roll it up.
Yeah, I don't know, Tom. What do you think? I mean, I think if we were to do that, we would have to state to our subscribers that some people don't like to roll trades like this. And since we don't know what our subscribers have, and we don't know what their situation is, we would not recommend that they roll. But I would say this is a trade with a sufficient amount of time remaining. I think some traders would actually choose to roll this up. Frankly, I'm more inclined for the purposes of the road trip trade service to leave it alone because we know it's going to make some money.
Yeah, it's a high probability of a win on this one.
Yeah.
And with all the time remaining, it's pretty far above the short strike, but there's still premium in here, so we can notch this thing up a bit more.
That's right. I mean, if we had a pullback, we can make more money out of this guy.
And at the expiration line, it's 766 on say 15 thou, so that's not a bad return just as it is. But we can probably get a little bit more.
Well, that's right. And remember, when you roll something, not only do you have the commission costs, but also you do incur more risk. I mean, some people think, well, this is so far away from the tent, I just will roll this, and now I'm going to make a lot of money. Well, okay, maybe you will, but now what if what if we have a very sharp reversal, which is not impossible given how overextended we are? Well, in that situation, you'll be sorry you rolled it. I guarantee it.
Yep. Now there is a lot of room. However, the markets can move. So if you do want to roll it up, roll at your own risk.
Well said, Tom. Yeah, exactly.
Okay, so the next one we have is our newest SPX trade. This is the September monthly trade. I like getting blue for some reason. Okay, so again, a new trade. This is right where we want to be, maybe a little bit higher, but it gives us some room on the downside. Very little risk, so it's looking good. Really, nothing to do with this.
Yeah, I think this will be a nice winner.
What point are you starting to look at reverse harving? I know we still have 69 days to go, so a lot of time remaining.
Yeah, and I had a question like that maybe a couple of days ago. I think it's way too soon. I mean, obviously, if we keep on moving up, but if you look at the one standard deviation, we're not even at the midpoint of the tent yet.
Yeah.
So I'm reluctant to do this yet. Particularly given that, I mean, one statement that I always make, and I think I've heard you say it too, is that just because the VIX is low and the skew is low, meaning the out-of-the-money puts skew is low, the calculation, the index, the CBO, the CBOE skew index is low, or normal, I should say. It's normal, back to normal. That doesn't mean that we have no more risk. When you start having 3 triple-digit Dow days out of 5, it has been my experience in 23 years that there's still volatility here. It may not be showing up on the indices that we follow, and the VIX futures are in contango except for 1 month. But that doesn't mean that we do not have volatility persisting. And in fact, I was looking earlier today at the Garch forecast for future volatility, which looks at a 4-year database of volatility, and there's a complicated formula for Garch. I'm not going to go into that. In fact, I don't even fully understand it. But basically, the assumption in the mathematics is that volatility over an extended period of time is going to revert to some mean, that it's a mean reverting type of parameter, just like the price. So anyway, the Garch calculation came to about 13 point something percent. And it is now higher than that. And if you look at the curves, they're moving down towards that 13.6 or 13.4% average, but we're not there yet. So the volatility is still relatively high and could get higher again before it comes back.
Well, and the other point is, you see we're here on the VIX, so it has come down quite sharply. But if the markets get active again, like the volcano erupts, then these standard deviation cones, as the volatility goes up, they start expanding. And you can see that in option view. If it's 16%, maybe we make it 18%. And we reload this and look at the T54, I think it was. T50, yeah, 54. It's I can't remember what it was before, but I think it's moved down a little
Yeah.
bit.
Yeah, that's a
So
good thing to show, because that's what actually happens. And so then that increases your risk, right?
absolutely. So here we are at 19, I can't read that, 82, and say we go up to a 25 vol. Well, now this T54 line is way down here at 1929. So that went down 50 points, 52 points for your standard deviation. It really expanded with that big increase in volatility. So you might think you're safe with your 16%, and the curve looks like, sorry, I got to put this in again. You know, it's up here. It's like, well, I'm good to go. But if we sell off, that cone can go zing way down here. Now it's not as safe as you thought it was.
Well, that's right. And, the curve looks good as the volatility is going up. It looks like you're going to make more money. And you might, if you can get out of it at a good price, if they'll let you get out of it at a decent price. But if you keep going, you're toast.
Yep.
Because you're really going to pay through the nose to get out of this thing.
So for now, bottom line is let it bake off a little bit more. So
yeah, going to let this thing percolate a little bit.
Okay, so that's it for the SPX. We have a couple in the Russell. So let's open those guys up. There's two positions open. This is what they look like combined, and you can see nice and flat T plus 0, and the gamma is nearly 0 as well. But let's look at them individually. Now these two, or actually just this one, this August 18th expiration has the benefit of that global put that Dan bought that actually made money versus lost money. So there's another $580 that's being added to this when I show the yields on the images because of that global protective put. But even without that, it's still making money, so it's still looking in good shape. And I think, yeah, 14,000 was what we had. Again, it's running out of time a little bit. It's still 40 days to go, but I wouldn't do anything right now because we've already reversed Harvey, and you can see the T plus 0 is not quite as flat as we'd like it over here, but
right.
But that's still pretty far away for it to move to get there. I don't think it will, but it could. So that's where we have the dilemma with the reverse Harveys. The more you do it, the more you start push this line down, and you're at more risk if the market does sell off. So
what's the probability of touch on that, Tom?
Let me look here. Probability of touch. And one thing on the probability of touch, it's doing a Monte Carlo simulation. So here it's 17%. I'll run it again. It's 16%. So it's random. So I usually run it a couple of times just to see, if it's varying a lot or varying a little bit. And this is 16, 16, 16, and 17. So that's got to be pretty close.
Yeah.
So that's what this is looking like.
But I would agree with you. We've already done quite a bit to this, and I'm reasonably, well, I'm very confident. Obviously, nothing is assured, but I'm very confident that this is going to be profitable, and we don't want to mess this up.
And if you just show like an extreme example of a reverse Harvey, this basically would turn it into a put credit spread. And you can see the big increase in risk, and you get a little bit more credit, quite a bit more. But is it worth all that extra risk for that little bit of extra return? Probably not. And you can see how far down your losses would be, even on just a kind of a mild pullback. So that's kind of illustrates what a reverse Harvey does. It reduces the amount you can make on a pullback, and actually you start losing money faster. So that's why we're careful. And this maybe that's one thing I learned from my brother is sometimes the best way to illustrate something is to really exaggerate it, and then that makes the flaws really obvious.
Well, that's exactly true, and everybody has heard of buyer's remorse, but if you did something like that and you got bitten, you, you'd have reverse Harvey remorse, and
That's
you'd be
right.
sorry you did that.
Okay, so really, just looking at the graph, it's fine. It's going to make money. We've already reversed Harvey it quite a bit. I don't see anything else we need to do with this, do you, Dan?
No.
Okay. And then the last one we have open is our Russell September trade. And again, this is new, just like our September SPX trade. So really, not much to do with this one. I'll go in T54. And there's the standard deviations for the target exit date.
And look at how that curve begins to pick up if we have a little pullback. So we don't want to give up too much of that potential profit yet.
Yeah. So again, this is one for the percolator.
Yep.
All right, and Dan, I think you wanted to share something with a 2 or 3 lot.
Well, I do. What I thought is that, okay, let me go ahead and do this. Share my screen. What I thought that I would do is periodically, maybe not on every cycle that finishes up, but maybe 2 out of 3. I thought for the subscribers who don't trade the same size or strikes that we show on the class page, I thought it might be worthwhile to show the way that a road trip trade would work on a small lot size. So I thought I would pick the 15 July, which is about to expire. So I went back into option view and I put this on the same day and the same strikes as I did for the class, but I just did a 2 lot, and you can see the thing there. 242 started on May the 3rd, and it looks like this. And so without taking a lot of time, I thought I would jump to a few dates, and we can see how this would perform. But before I do that, I wanted to say that the guidelines for a small lot road trip are different from what we do on the larger size. And the differences are these. Number one, the only adjustment that we make is to do a reverse Harvey on the upside. We don't do anything on the downside. If we're losing too much money, we simply leave, we exit. The only thing we do on the upside, if we do a 2 lot, we would do a 1 lot reverse Harvey. If we had a 3 lot, we might do a 2 lot reverse Harvey. So this is truly a road trip trade because you don't really do anything. So I thought I would just go ahead and once again, in the interest of time, we'll go to June the 2nd. I have made just a couple of notes here of things just to show how it works out. So here we are on June the 2nd, and we're up $156 already. Once again, we have done nothing. Looks like that. We'll go to June the 10th, and I did a reverse Harvey on this because we had run up a lot. You'll see it in a second. So there you
I think you could drag that bar separating the puts and calls higher, and then
yes,
you could probably see the whole trade at once then.
I can do that. That's a good idea. Yeah, thank you. So there you can see I did that. So I did the one. So this is the guideline. You do a 1 lot reverse Harvey if you have a 2 lot position. If you had a 3 lot, you might do a 2 lot reverse Harvey. You might just do a 1 lot. So we look like this, and so you can see why I did that, because we've moved a long way up. There's the 1 standard deviation well to the right side of the peak of the tent. So now we'll just carry this thing forward. we'll go another week here very quickly to June 17th.
I think if you can scroll that down a little bit, one of the puts is off the screen.
Oh, yeah. Scroll what down?
You can actually click that down.
Oh, there
arrow.
it is.
There you go. Yeah.
Yeah, thanks. There it is. Yeah. Yeah. So, yes, so I did a reverse Harvey on both sides. I think I failed to mention that. You do want to do both wings on this. So there's the reverse Harvey on the upper wing, and there it is on the lower wing. And now we're up 165, and we look like this. And you can see things are happening here. We'll go to the 24th. We're getting near Brexit time.
I think Brexit was the 23rd, right? That should be the day after Brexit.
I'm not sure.
Yeah, here we're down 55, so yeah.
Oh, yeah, that's it, right. So, yeah, there it is. So, so there we are now, but we're still making money. We're up 185, which on a yield basis is this was I'm going to have to enter this by hand, but it was $2,300, I believe, is all this cost. Whoops. So on a yield basis,
it's about 8%.
Yeah. So we're up about 8%. So if anybody wanted to, you could take this off and say, hey, I just made 8% and I didn't do anything. Let's carry this forward to the 29th. And if these prices are true, check this out.
Oh.
Now, I'm not sure if those prices are true. What do you think?
Well, it could be. I mean, look at the curves. It looks about right.
The curves look right. And this is a yield. Oops. Pardon me. I didn't mean to click that. So this is a yield. So if these prices are true, this is 21%. And you didn't do anything. But I'll finish up by doing this. We're going to July 7th, which is the third. Well, we'll go to July 8th and look at this. You had 465 or whatever it was. Now you're down 90. So I don't think I need to belabor the point on you're taking your money when you have it, right?
Absolutely.
So that's an interesting trade. And then I'll just finish up here very quickly by showing for those that might be interested, this is an example. Again, we can't make any specific trade recommendations, but this is an example if you were to set up a 3-lot, we'll say, for the September. Now, I'm not sure I mentioned this. I guess I got to go back. When did I start this? I got to go back a few days because I forgot when I started this. I think the 5th. When you're doing a small lot size like this, you may want to make your wings a little narrower. For the big lots that we do for the class, we may use a 50-60 or a 50-75 or a 60-75. Tom even uses, I think he uses 75-100 sometimes, don't you, Tom?
I do. Mm-hmm.
So that's what you want to do on a big lot size, especially in a period of increased volatility. But for a small lot size, since you're not going to make any adjustments anyway, that's the guideline. The only adjustment is the upside reverse Harvey. You can make the wing width a little narrower. At least that's my take on it. Would you agree with that, Tom?
Yeah, that definitely keeps the cost of the trade down.
And which is right, and that's exactly what you want to do. And see, this one was put on. The most you could lose is $17, and you would treat this one the same way. So, sometimes I do these in my own private account. One thing that I sometimes do in my own private account, not the one that I show for the class, is sometimes I will, either alternate a a big position, which I may layer by superimposing other things on top of it, which we can't discuss in the road trip service, but layer a big position for one cycle, and then one other cycle in the same month I'll have a small lot size that I really don't have to fool with, because I'm just going to let the thing either work or not. So there's a lot of versatility here in the road trip style of trading. You can have a basic road trip, either a larger lot or smaller lot size. You can layer things on top of a road trip. If you're more advanced, when you have a small size like this, you can just let the thing alone and live up to the name of road trip trade. So lots of flexibility there. So I'm just going to leave this one on just for kicks and follow it through and see how it does. But again, the guidelines are, and so this is a 3 lot. If we keep running up, I will reverse Harvey either 1 or 2 of the of the position. If we keep going down, I just look at the P&L. I do nothing else, but I look at the P&L. If I've made a sufficient amount of money, I take the money and go out to dinner. If it moves down really quickly, I just take a small loss. And you're not going to lose much on this, as you can see from these numbers here. So like, let's see, I guess I can make this like a T1, huh?
Yep.
T1. So if I made that a T1, so that's this line. So see, there you're only down $200, and you got to go all the way from there to there, and you're only down $200. And if you and this is not going to happen in one day, of course. So if I made this next one T10, and T10, and you went all the way down there, you'd actually be up 122. And at that point, you might just say, well, we blew through the tent. I'm up $100. I'm going to go out to eat. It may not be quite as fancy, but I'm going to go out to eat anyway and take the money. So lots of flexibility here.
Sure
so Tom,
is.
Any comments on that?
No, I like it. It's nice and simple, easy to manage. It's good.
Yeah.
Last thing, I think we've kind of gone a little long. Sorry about that. But any plans for the next road trip? I know we've got one on in September for week 3. I think you were talking about one at the end of the month, Dan.
That is what I'm thinking of, and obviously you and I will talk about this again. But I was thinking about the one at the end of the month, which is a quarterly. But I've already looked at it. It seems to be pretty good liquidity and lots of strikes at the area that we're interested in.
And just a little teaser, Dan and I are working on a little planning tool that we'll be able to type in thoughts about what we're going to do for the day, or how we're going to adjust given certain market conditions. And some will be checklist items that you can see that are checked off and they're done. But you'll see that on the member homepage and also on the class page. Kind of like an announcement with a different background color. I'm thinking of light green, just so it stands out. But that's something that's coming probably this week. You'll see that. But I think it'll be a help.
This is going to be really cool, folks. I think you'll be able to see at a glance what we are thinking about, not only for the coming day or the current day, but maybe 2 or 3 days in the future of things we're going to be doing. It'll be like a bulletin board of announcements, and it's really cool. Tom showed me the code on this, and I have to say, my eyes started to glaze over because I am completely and totally ignorant about the code, and I didn't understand any of it, but it's going to be real cool. That's all I can
I think
say. And
we
then
hope so.
yeah. And then at some time in the future, fairly soon, we're going to be adding some things to probably the tool page, like the VIX, the RVX, the skew, and I will add the Garch future volatility forecast and the IV percentile. Those may be helpful to look at a glance and see where we stand, and we may add some things to that from time to time. So again, we're trying to make things good for the subscribers. We want you all to get your money's worth and feel that you have your money's worth, and at the same time get some useful information which will help you in your trading.
Absolutely. And I go to the class page all the time for the tools, so it's useful for everyone. So it's great.
Yeah.
But Dan, thanks very much. Thanks everyone for following us. We appreciate it, and hopefully we'll have a good week coming up and some new tools, and hopefully the trades all behave.
And thanks, everybody. Appreciate it.
All right. Thanks.